Your resume is just full of all these incredible transformations. And another one that I spotted was when you were at PayPal, they spun out from eBay under activist pressure. What's your biggest takeaway from leading finance through such a pivotal moment?
I think it was a very powerful relationship for PayPal to be part of eBay because, PayPal and eBay got started both at the origins of e-commerce, and PayPal was being the sort of the digital currency, if you will, for the internet. And I think it solved a problem for eBay as well, which was to create safe and secure way for people to pay. And then as eBay went into new countries and went into new forms of commerce, PayPal was able to benefit from that as well. And then it went off platform into just its merchant business was, hey, we can do that. We've done this for eBay. We can do this for any e-commerce merchant around the world.
If you're a shareholder in eBay at the time, you're probably looking at it like there's a lot of value that could be unlocked if these two were separated, right?
That's exactly what Carl Icahn and team thought, as they called it the jewel in the crown, and said this business should be on its own.
Is this thing on?
Yesterday's price is not today's price.
Welcome back to the Run the Numbers podcast. Boy, do we have a good one for you today. I have multi-time CFO, multi-stage CFO, Mohit Daswani on the podcast. And we're talking to a CFO who's had a front row seat to the full spectrum of business models here. We dig into how the CFO mindset shifts across those stages. How do you weigh risk when you've got VC capital eager to fund big ideas, even if they don't pan out? What changes you might make if you're operating under a public markets microscope, where a short-term stumble can tank your stock, even if the long-term vision is sound? And how do you operate with discipline in private equity, where the whole period may be fixed, but the opportunity to build future value for the next owner, it's very real. From there, we dive into metrics, how the Rule of 40, gross margin, and valuation benchmarks shift across financial contexts, and the danger of using valuation as a personal scorecard. Spoiler, $100 million business outcome shouldn't be a failure. It all depends on what the expectations were. We also go deep on growth versus guardrails with war stories from PayPal, Square, and spinning out a $10 billion public company under activist pressure. What does it take to place a bet on mobile, consumer products, even super apps? And when don't those bets pay off? What do you do? This episode is packed with stories, strategy, and the kind of capital allocation wisdom that only comes from seeing it all. From Series B term sheets to billion-dollar spinouts to billion-dollar public companies, Mohit has seen it all. All this and much, much more after a short word from our sponsors. Ready to plan confidently, close faster, and report with accuracy? Here's what sets Planful apart. Imagine purpose-built solutions for every department, from FP&A to accounting, marketing to HR, all with built-in financial intelligence. It's easy to implement Planful in just weeks with minimal IT involvement, enabling seamless collaboration across your organization's key financial workflows. Best of all, Planful grows with you. Its unmatched scalability ensures that no matter how fast your business expands, Planful can keep up. See why over 1,500 customers worldwide choose Planful as their flexible, user-friendly, end-to-end financial performance management platform. Visit planful.com/metrics to see how you can elevate your team this year with Planful. They will hook you up. It is planful.com/metrics. Tell them your boy CJ sent you. Planful.com/metrics. If you're a CFO trying to keep up with usage-based billing, complex contracts, and a finance team drowning in spreadsheets, listen up. Meet Tabs. Tabs is the AI-native platform automating contract to revenue for finance teams that are scaling fast. Whether you're selling custom terms, usage-based pricing, or a mix of PLG and sales-led, been there, Tabs turns month-end chaos into clean cash flow. It's like having a controller that never sleeps and a billing analyst who actually understands your pricing model. No more manual reconciliations, no more late-night close deadlines, just clean data from contract to cash. It used to drive me nuts that we do all the work to close the books inside our ERP in our FP&A tool, and then we had to export the most important part, revenue, to this janky spreadsheet and manually calculate what we did that period. And don't even get me started on the back of the envelope calcs we did to get to ARR based on all the unique contract terms we had floating around. Our investors would wince if they knew. Let's be honest, legacy systems here are not going to cut it, folks. Tabs is the system I wish I had in my CFO days. Fast-growing companies like Cortex, StatSig, Cursor, and others are already using Tabs to instantly generate invoices from any contract, automate RevRec, cash application, and get finance out of manual mode. If you want to automate the mess and fix the way money enters the building, baby, go check out tabs.inc/metrics Again, that is tabs.inc/metrics. And if your team's still closing the books like it's 2015, now's a good time to upgrade. Hey, metrics fans, let me ask you something. Do you know what keeps CFOs and finance teams up at night? Well, it's not the complex analyses or forecasting models. It's the mind-numbing tasks of chasing receipts, reconciling expenses, and juggling 5 different systems just to track company spending. I was talking with a finance leader last week who calculated her team was spending an astonishing 20 hours weekly just on expense administration. That's nearly 1,000 hours annually on low-value tasks. That's why I'm excited to tell you about Rippling Spend. Rippling Spend is the only platform that automatically handles your entire company's spending in one unified system. What makes it different? It's built on Rippling's workforce platform. So when org changes happen, like someone getting promoted or changing departments, all approval workflows, access permissions, and policies update automatically. Picture this. When your marketing director goes on vacation, expense approvals don't sit in their inbox waiting for their return. Instead, they're automatically routed to the right backup approver. No manual delegation needed. Meanwhile, your finance team gets real-time visibility into all company spending with no more month-end surprises. As a Run the Numbers listener, you can get an exclusive demo showing exactly how much time your org would save. Just visit rippling.com/metrics to learn more. That's rippling.com/metrics. Do it, guys. Mohit, so excited to have you here. Thanks.
Thank you, CJ. Looking forward to chatting today.
So I'm obsessed with people's backgrounds and what they have in it, what the meaning is. We had a CFO on the podcast, Michael Bayer of Wasabi, and he had a sloth behind him. And I was like, why do you have a sloth? And he said, because the office of the CFO, sometimes it's not all that approachable. So I put the sloth behind me just to make it seem like I'm a funny guy, which he was. But tell me about that coffee cup first and foremost.
Yeah, so this is a throwback to, old school kind of New York diner or coffee truck coffee cups. And when I started my career back in New York, that was how I started my day. And so it's kind of a throwback to that, but never been a big Starbucks fan. I just feel like it's everywhere. So always looking for something unique if I'm on the road as far as a cup of coffee. But I keep that just because it's almost it's an era gone by, in terms of just these little boutique coffee shops and coffee trucks sitting outside the office. And so I keep that as just a reminder of that. And some good memories.
You always see those blue Greek style coffee cups in the movies. And it caught my eye. I was like, oh, that's it.
Yeah, no, that's it. And it's actually, that one's ceramic. It's like, it's become a work of art. I think I bought it at the MoMA store or something. So it's become a part of New York, cultural lore. And it was very much part of my early part of my career.
I love that. I bet you had a couple thousand cups of that.
It's pretty funny. I actually, New York, there's just such an adrenaline in the air and everything's going so fast that I actually didn't need a lot of coffee. I drink more probably now than I did when I was pulling all-nighters, just because you're running on adrenaline and energy and all the stress in the environment, very frankly.
All right. Well, one more question. What's the quote behind you in red?
I was in London a couple of summers ago with my family. We went to visit the Churchill war rooms where he directed the war effort in World War II. And that was in the gift shop. And, it says, if you can't read it, your courage, your cheerfulness, and your resolution will bring us victory. And what I thought was funny about that is, you don't think of cheerfulness when you're thinking about directing a war effort or just when times are stressed. I think it's a good reminder as a leader that you do, you got to push, you got to have resolve, but you got to keep it real with your team and keep things light sometimes just to help reduce the stress. So positive energy and just keeping things cheerful can help when people are pulling their hair out around you. So I love that quote. I wouldn't have thought of that in the middle of World War II to think of cheerfulness. So good reminder.
Well, I'm positive, I'm cheerful, and extremely caffeinated, and excited to have you here today.
Nice.
And
awesome.
I wanted to start out by talking about risk a bit, because I was looking at your resume, and you've operated in venture-backed, public company, and private equity environments. And so, where does your mindset go with risk and return, and how that shifts across these models?
Yeah, it's super interesting being in a CFO seat to think about that, because ultimately that's a big part of the environment you're operating in becomes a big part of how you do your job, right? And what does that mean? I mean, you're working on capital allocation, you're working on trying to think of the kind of bets you can take as a company. And so having worked across those introduces, really, each of them are quite different. So if you think about venture, Venture is willing to take big bets. I mean, it's the beauty of this capital, kind of pool of capital we have. You have a dream, you have an idea, you can go pursue it. But there's a high failure rate, right? I mean, I think maybe if you look at the stats, it depends, 30 to 40% maybe. Probably at most of venture-based backed bets end up with a successful outcome, meaning generated return for investors, through an exit, an acquisition, or obviously an IPO. So that means a lot of them don't work out. They have suboptimal returns or even zero. So what does that tell you? It tells you you're playing for, you're taking a big swing. And so you're shooting for the big outcome. Even if it means sacrificing, you could have a smaller outcome, right? And that would be perfectly fine. You're not playing for that in the venture-based game. You're playing for the big $1 billion plus type outcome. So, as sitting in the CFO seat, that's what you're there for. Now, there's limitations to that. And I think, we'll talk a little bit about that today. I think you end up with a lot of companies that could have been really good mid-sized companies with good returns, but they raised money too much or what have you to end up having that be an outcome that investors are willing to accept. So you're taking big swings, and as a CFO, you're looking for those bets that could turn into big bets. On private equity, you've got a more defined hold period. I think everybody recognizes growth is more valuable than just margins, right? So don't just drop every dollar to the bottom line, but they've got to be in the right ratio. And if you're going to make a bet, show me how that'll play out. Show me how it's additive to the business in a way that accrues value, right? What are the proof points? What's the time frame in which I need to execute? What's it going to cost? And yes, if it's accretive from a financial perspective to a business, then let's do it. Otherwise, we're better off driving efficiency in the business. So I would say, there's a willingness for risk, but it's got to be measurable. It's got to be defined, and you've got to execute and show against it versus take 2 years to see if it pays off. So I think venture bets are willing to take a longer term horizon, which introduces more risk. The public side really is, hey, obviously do what you told me every quarter, right? Build my confidence in you as a company that can operate. But ultimately, if I look at it, if I look at Square, the thing we'd start with is we played in massive TAM. Square plays in a massive market SMB, and then, overall commerce, as well as now on the consumer side, obviously with Cash App, huge, hundreds of billions of TAMs to go after. So no limitation there. And so then what you're trying to prove to investors is that you have the right to win in those spaces, and that you can go and continue to grow your business because of your execution, because of a product differentiation that you have, some other, advantage that is the reason that, hey, yes, as an investor, you should invest in this market, and now here's why you should invest in us. And you continue to prove quarter in, quarter out your right to win in that market. So I think they're willing to take a long-term bet. I think the reason a lot of companies aren't going public today is investors are saying, can this be a several billion-dollar company over time? If not, it's less interesting for the public market. So they're willing to see you through over a long period, but you've got to be very careful and deliberate in proving along the way that what you say you think you can do, you do, right? Those are obviously, kind of just pithy comments around it. But if I think through, sitting in the CFO seat and each of those environments, that's kind of how I've tended to approach it.
That's an incredibly helpful overview. And you can see how you have to understand the range of outcomes that your shareholders are willing to underwrite at each level. And if I zoom in on the venture backspace for a second here, how do you think about dialing in financial discipline versus leaving room for growth and investment?
Yeah, and I think the market's in flux. Obviously, we're in the early stages of a new market evolution in AI, and we're still going to figure out what do those business models look like, what will gross margins look like in the world of AI, et cetera. So I think, frankly, we're in more just, hey, let's see if there's revenue traction and things that can stick. But if I think about my experience, having just been in SaaS and in that world, what I would say is, obviously, it depends on different stage, right? Certainly today, if you're at a company that's approaching 100 million in revenue plus and you're a software company, Rule of 40 has become a big focus, which is you're at a stage now where you should be able to demonstrate the right mix of growth and profitability. Maybe 100's a little small, but I think it applies there. Certainly anything above as you get to 150 to 200. And so I do think that discipline has come in just because it's frankly required to get to your next fundraise or exit or what have you. But if you sort of take that apart, like that top-down view, I think what I've seen tended to see is, hey, one is what's the unit economics of a business? That's the early stages of proving out the value of a business. Is this a business that's, like many SaaS companies, can drive a 70% or to 80% gross margin? Do we have the pricing leverage and unit economics to do that? Okay, that's a starting point, right? And if you can, well, that's a powerful thing. Now let's invest in product and go to market behind that to continue to grow it. Go to market, like if you think about, there's different metrics of efficiency, payback period, and LTV to CAC. In the heyday of 2021, people were saying, hey, a 2-year payback is fine, on go-to-market spend. That's tightened up, and I think we'll see where it settles out. But it was for a while, it was 12. I want to see it in 12 months, right? So yes, invest in growth, but be able to go get that back from new revenue contribution in less than a year. My guess is that will vary, but depending on where we are in the growth in the markets, but that has tightened up. And then product, I think it has to be, how does this grow your TAM, right? Or is there, as you add product capabilities, what will that do for our ability to grow the business, as opposed to let's just invest for innovation's sake? And look, most venture companies will feel, they need to continue to invest in product and development. It's a key part of the ability to deliver value to your customers, especially with AI, now adopting AI tools, et cetera. If I think about, my last company, ThoughtSpot, very much looking to continue to innovate with AI in their end market. So it'll always be a part of it. But I think there is now more focus on, okay, if you're at scale, let's call it 100 million plus revenue company, it's got to be in the right mix of growth and profitability, as opposed to just let's make a lot of bets and see whether or not they pan out and just drag out the burn cycle. I think there is a more of a balance now, and which is probably a good thing for just as you scale and build a company. I would put AI separate from that, because I think AI, people are willing to make a lot of bets right now with unknown outcomes, and we'll kind of figure it out as we go.
Hey, thanks for listening. We'll be right back after a word from our sponsors. As a CFO, you're expected to bring clarity to everything, including how your company manages ownership. The tools you use should make that easier, not harder. But when they come with hidden fees, data you can't always trust, and support you can't rely on, you end up with more frustration than clarity. That's where Pulley comes in. Pulley is the cap table management platform built for finance leaders who need accurate, decision-ready data from a system that works for your business, not against it. With Pulley, you get intuitive workflows, audit-ready reporting, and support you can count on, all backed by predictable pricing you can plan around, so you can stay compliant and make smarter decisions about your company's future. Manage everything from fundraise modeling to ASC 718 reporting to custom liquidity programs, all on one trusted platform. Hundreds of high-growth companies like Linear, Fathom, and Runway trust Pulley to help turn ownership into a strategic advantage. And joining them is now easier than ever. You can switch to Pulley in as little as 5 days. And for a limited time, they're offering 25% off your first year. To claim your exclusive offer, visit pulley.com/mostlymetrics. That is pulley.com/mostlymetrics. pulley.com/mostlymetrics. Here's a question. When was the last time you really had time to focus on growth and not chasing contract renewals, tracking shadow IT spend, or explaining rising software costs to the board? Yikes. The truth is, traditional spend management is broken. If you're still piecing together data from 5 different systems just to figure out what you're actually spending, while vendors keep on pushing those auto renewals and price hikes, my friend, I got a solution for you. That's where Tropic comes in. Tropic is an intelligent spend management solution that consolidates your spend data and processes into one unified offering, enabling insights and decisive action. It doesn't just show you where the problems are, it helps you solve them. From spotting hidden optimization opportunities like duplicative spend, to automating those painful procurement workflows, to giving you the best market data that turns every vendor negotiation in your favor. Tropic combines smart insights with real human expertise to keep you ahead of the curve. And I can say firsthand because I've used them for over 2 years. Their SaaS platform helps me with price checks. It helps me keep my calendar organized of when renewals are coming up and I can actually visualize it. And let me say, it saves me more than 10 hours a week on vendor management, and we've saved a ton on renewals. I'm walking into the boardroom with a lot more confidence. Isn't it time to turn your spend management into your competitive advantage? Visit tropicapp.io/mostlymetrics. That's tropicapp.io/mostlymetrics. What does the future hold for business? Ask 9 experts and you'll get 10 answers. Bull market, bear market. Rates will rise, rates will fall. Can someone please just invent a crystal ball already? Until then, over 40,000 businesses have future-proofed their companies with NetSuite by Oracle, the #1 cloud ERP, bringing accounting, financial management, inventory, HR into one fluid platform. With one unified business management suite, there's one source of truth, giving you the visibility and control you need to make quick decisions. With real-time insights and forecasting, you're peering into the future with actionable data. Whether you're closing the books in days, not weeks, you're spending less time looking backwards and more time on what's next. If you listen to this podcast, you'll know I ask CFOs all the time to rep their tech stacks, and I would say almost every one of them use NetSuite. And that's what I would use too. Whether you're a company earning millions or even hundreds of millions, NetSuite helps you respond to immediate challenges and seize your biggest opportunities. Speaking of opportunity, download the CFO's Guide to AI and Machine Learning at netsuite.com/metrics. The guide is free to you. That is netsuite.com/metrics. Ooh, yeah, it's netsuite.com/metrics. Please, guys, I really need this. So I'm interested to hear what your perspective is of how that jives with the private equity space these days. And now you find yourself in a private equity CFO role, and that is more defined than its investment horizons, I'd say. It's interesting to know how you have to balance the tension between short-term performance and these long-term strategic bets that may only pay off for the next owner.
So if you think about just like stepping back, right? I mean, we go through cycles of what's in vogue from a financial perspective. Invest more in growth at all costs, pull back. Now you got to be rule of 40. I mean, if you put that aside, ultimately as an investor, are you in a large market, right? Do you have a right to win in that market? Can you do so in a business model that's attractive and generates good gross margins? And then are you a management team that knows how to, figure out capital allocation in a way that, makes some bets. They may not all pay back in a year. You may have some product, but you've shown, the ability to go deliver and execute against them. That's, I think, when I sort of, in a nutshell, what would make for an interesting company for an investor. And so from a private equity perspective, yes, there is obviously a shorter hold period, more defined hold period, not 10 years, but, it's going to be, call it 3 to 5 years typically. But at the same time, there's a recognition that for the next owner, whether it's the public markets or another PE firm or even a strategic acquirer, you have to have shown the ability for that company to continue an attractive growth rate, right? Because if you've just squeezed lemon and all you've got left is high profitability, not much revenue growth, that's going to impact your value at exit. And so any rational investor is going to think about that and say, if in fact the growth is not there, the market's changed, then yes, let's just maximize profitability because it's the right thing to do. But if the market is large, this company can execute. Let's continue to put resources there because that's only going to help the next owner and the ultimate trajectory of the business. So it's a very rational approach, which is what's the right structure for that company based on where they are in their growth cycle, in their maturity, in their ability to execute, all of that. And so there isn't just one PE framework, but there's a lot of PE companies, deals that got done where companies got taken private and now will go back out and go public because they were able to make changes, whether on-prem to cloud or fixed a cost structure as a private company aware from the glare of the public markets, but still have set that company up for long-term success. So there's a bit of a misnomer, which is and it's not saying this is the intent of your question, but PE can be thought of as like it's short-sighted, it's just maximized for the next 3 to 4 years. No, any investor knows that long-term value for a company is going to benefit from setting it up to succeed in the best way possible.
And you have to incubate engines for growth in any company that you're at. It's just how much do I want to be risk on and bet on things that potentially may not pan out?
Yeah, exactly. How much risk do you want to take on stuff that may or may not pan out? And yes, there are some companies where the market has matured. There will be some companies in software where AI has fundamentally changed the value prop for customers. And you probably have to recognize that if you are one of those and say, okay, what is our best leg here? Can we pivot? Can we not? So not to say that some companies have run through a lot of their growth curve and now are more mature. But putting that aside, if you do have levers, and that's what I've always been drawn to is companies that have still, an attractive growth opportunity in front of them. I think an irrational investor will always be looking to take advantage of that and invest behind that.
Mohit, I'm a total dork when it comes to studying the unit economics of companies of all different shapes and sizes. And I heard you bring up the rule of 40 earlier. I'm curious what your thoughts are around rule of 40 and gross margin and benchmarks depending on the financial model of a company, because you've seen the rule of 40 and gross margin at all sorts of different types of companies.
It's so funny that rule of 40 has stuck for so long.
But when do you remember it first starting?
I mean, I started paying attention to it more as when I was doing growth equity investing in software. This is over 10 years ago now. And then it really wasn't a thing as much, obviously, in the, heyday of SaaS investing in the 2020 and those next 4 years. Well, late, teens into, early 2020s before kind of the market popped. And then it came back in full vogue. I guess my point is this, and Bessemer has evolved the study. It's interesting that the rule of makes sense. 40 being the number, it's interesting that has stuck. But I think if you look at even what they've come out with, you're a student of these businesses, it's rule of X. And it does vary based on where the market is and what it's favoring. And then, when the markets are robust, it's grow, grow, grow. But if you look at over time, what they've said is the ratio tends to be that growth is 2 times more valuable than profitability, right? So when you plot it out, you need to have both, but they're not both as valuable in equal measure. Growth will be. And that kind of, again, back to the earlier point, that makes sense, right? A company that's growing 10% with a 30% margin, hey, you got a rule of 40, but the market's telling you something about their ability to grow and create longer term value and compound away versus the inverse, company growing at 30% with 10% margins. Okay, you've been able to get profitability. You've got, I would imagine, good unit economics to be EBITDA positive, but you're still growing the top line 30%. Wow. When I forecast that out, I can see you compounding away and generating value. So it makes sense, right? It kind of makes sense. And so I think it's rule of X, and rule of X tends to be, from at least when you look at the studies that have been done that Dave Bessemer's done and others, sort of growth is about 2 times more valuable than profitability.
What I always struggle with is if rule of 40 or rule of whatever, because it's a compound metric and it takes into consideration both the top line and the bottom line, if you should use it equally across, or apply it, I guess, equally across venture, buyout, and public settings, or if it favors one or the other.
Yeah, it's a good question. I think it's definitely not relevant in an early stage venture company where you're trying to figure out product market fit, and you're in the J curve.
Yeah.
Like when you're in the J curve, growth is off of small numbers, right? So you do, and I'm used to the SaaS world used to be like you'd go triple, double kind of thing, right? Go 3, 10, 30, 100. That would be a great outcome. Those numbers have changed a lot in AI land today, where companies are, as you know, getting 100 million AR in 18 months. It's quite astonishing. But if you put that aside, if you're in that really steep growth curve and you're triple digit growth, yeah, rule of 40 kind of could come into play, but you're in the investment stage, right? So you're investing in product. You're mature on the revenue side. Where I look at there, as we were talking about earlier, is okay, can I get to a unit economics gross margin on the business that makes sense? And if so, keep investing behind it, grab market share, build brand awareness, do all the stuff that comes in early stages of scaling. So I don't know if rule of 40 is as relevant there. I think more it's, core unit economics. Look at payback periods, look at how long it's taking you to acquire customers and all that. Hopefully that's starting to show up. So I don't know at what level. Is that a 50 million? Is that a 100 million threshold? It's an interesting question. In my mind, certainly triple digits and up in like a company, like a software business, which can generate such high gross margins. Yeah, you should be able to start be demonstrating a rule of 40 type profile. And even if you're burning, that means you're investing behind it. You're growing 50% a year, you're burning 10% on margins, fine. So there's some scale. I don't know what but there is certainly less relevance, I think, in an early stage venture. You asked about private equity. I think it is definitely relevant in private equity. I think as well, like I said, it's more of by definition, PE-backed companies tend to be of a greater scale, right? Just where they invest. And so you've already gone through a lot of that early stage growth, come into more maturity as a company. And so at that point, it is more of a bottoms up exercise around if there's opportunities where we can bend the curve on growth, yes, let's do it and execute and show that. But if not, yeah, let's favor towards profitability and drive efficiency, in a business. And so it's really that kind of, analysis with, to the discussion earlier, 40 still being kind of a real benchmark. It's still, that number has stuck. And so as long as public markets or ultimate next generation of investors are looking at that as an exit, then yes, you want to kind of clear that 40 threshold. But like I said, I do think if there's an opportunity to invest in some growth, I think rational investors are going to do that because it is more valuable than margin.
I was talking to CFOs at 2 very different companies recently. So one was at a AI company that's just gotten through 100 million pretty quickly, and they were growing at 150% year over year, and they had 100% burn. So it was a rule of 50 company on paper. I was talking to another CFO, company's at about 400 million in revenue. And I asked him what his growth rate was, and it was like 8%. And if you did the math, they were also a rule of 50 company. But to me, those are like two fundamentally different, like two very different businesses.
Yeah, they are, which is why they're, I mean, exactly. There's a great example of which I think is what the updated, why the rule of X, because it is a ratio of growth to. So what I've seen is the adjusted rule of 40, which is 2 times your growth rate plus your EBITDA margin. Where are you on that? And that's what you see. I've seen plotted where there's a little bit more of when you do the linear regression on relationship between that and at least in the public market valuations, I've seen that be a study pretty common over the last year. But if you did that math, right, think about that, right? You're growing, one company's growing, at a significantly higher rate than the other. It's worth more. It's just worth more because growth is, and that one's an even more extreme example that you gave. So,
Mohit, I want to segue this into talking about valuations, but I think in order to set that up, I'm curious to get your thoughts on the private equity model and more specifically what people from the outside may get wrong about it, because in the news and just in how people speak about it from time to time, it does get kind of stepped on and get a reputation that may not be completely accurate.
Yeah. No, I think, first of all, as an industry, I think we're at $3+ trillion of assets in overall the venture through private equity LBO asset class. And that's grown significantly and will continue to, right? There's, retail investors soon will have a chance to invest in directly in private equity firms like Blackstone and others have gone public. So it's become, from a cottage industry, maybe 20 years ago, a lot more significant and permanent part of the overall, financing picture for companies, especially in the United States. And so that's one, right? It's not a cyclical trend, or it's had its boom and bust in the past, over leveraged, this and that, early days in the industry. It's now become a lot more stable source of capital, which I think is a good thing. 2, you've just had the public markets go through a lot of change. We're still not back to fully healthy public markets. This year is supposed to be a good year, and now we've got the noise and tariffs and who knows, the uncertainty going on. Markets are trading off obviously this week, but it's starting to trickle back out. But the IPO markets as well, and what that'll look like, has changed. And so I think a lot of companies that may have been thinking, hey, I'm going to end up being a public company, et cetera, may very well end up being a private equity backed company. And that used to be used to be thought it was a failure. Let's talk honestly. Like in the Valley, it's like, oh, if you got sold to private equity, it wasn't the home run outcome you were hoping for. Fact of the matter is, you used to be able to go public as a SaaS company at 150 of trailing revenue, going to 200. Probably not the case today, right? AI companies, I imagine, might, as the market gets receptive to AI, but certainly in more traditional tech, that scale will not get you there. And that could be a perfectly good business with great customers, a good end market, growing nicely, but is not a big enough, when we go back to what are IPO public investors thinking about, what's your TAM, what's your opportunity to compound over time, may not have that. And so that company may be ready for a cap structure in which there's some leverage, because debt, is at just lower cost of capital, is very accretive to an investor base. And so start to take advantage of some debt, which is a key part of the private equity model. Thought it was a bad thing. It's not. A company that's generating cash flow, if a third of its or half of its cap structure can come with debt at a 8 to 10% cost versus more expensive equity, there is nothing wrong with that. Don't overlever it, right? Don't kill the company, but there's nothing wrong with taking advantage of an efficient cap structure. So that's one. And people underestimate that, just the power of leverage in a business to go and then drive a return down the road. And that accrues to all equity holders. And then 2, it's just PE firms have evolved. It is not like buy low, sell high. It is not just come in and cut costs and flip it. If you look at a lot of PE firms, they do have a whole operating team. They have a team that's come in with playbooks and best practices to help you build that business. And there's value there. And there's a lot of learning there over a large portfolio that a management team in one company may not have. And so I think they've also recognized, if we're going to, it's competitive for deals. You're going to have to pay full value for a deal at entry. It's hard to find a off-market deal somewhere. So assuming you're going to have to pay full price in a competitive process, you have to have some things that you can do to build value. And so those playbooks, I think, are helpful. And then ultimately, it is different. It's not the venture-backed model where you have a lot of running room and willingness to take a number of bets and maybe 1 out of 3 bets pay off, which is fine. That works in that stage. This will be more like a focus on execution and delivery against that. I will say, sitting as CFO in a seat where it's about like value creation, partnering with the CEO and the management team on capital allocation, and wanting to see the results from what we put out, I think it's a good discipline to have. So I think the role of private equity is here. It's permanent. It's larger. And a lot more companies should probably consider it than, we're versus thinking about the traditional, hey, I'm going to go public, and that's going to be my end game. It's a perfectly good outcome. And with the right partners, I think can be, a way to continue to unlock value in a business.
And you had mentioned the wonders of using leverage. Can you unpack some of the benefits and why it accrues to all the shareholders, not just, the private equity players?
Well, if you're at for example, if it's a change of control transaction and you are, as a management team, right? Think from that perspective, joining the company, you're sharing in the equity pool alongside the private equity investors, right? And some kind of management pool. And so then you're sitting there alongside. Why does it help? Ultimately, you're raising capital as a business, and you have to clear the threshold of what that capital is going to cost you to be able to make a return as a shareholder. And that debt is, call it 9-10% today to get, sort of all in, let's just say, and is paid off at the point of exit. Okay, that's a source of capital that was relatively cheap relative to you're looking for 20+% returns as an equity investor, which is more expensive. And so, simple math, if you buy a company for $100 and you use debt of 50 and equity of 50, and then you sell it off down the road for $200, let's just say. So you've doubled the value, quote unquote. If it was an all equity transaction of $100 of equity, 200 exit, you would have doubled your money. But you've used 50 of leverage, and let's assume that that debt gets paid off over the next 5 years. So now your 50 is gone to 200 because there's no debt left, right? So you've made a 4x. That's the power of leverage. Now balance it. Make sure it's not sucking up all the interest payments aren't sucking up all the cash flow of your business. Leave yourself some room for breathing room. You can get into trouble with over leverage. But at a simple math, like that's the power of leverage in a buyout. And if you're sitting there along the PE sponsors in an equity seat, that value accrues to you as well. So that's my point. That's just all equity. People underappreciate, I think, how hard it is on an all equity structure to go drive that return, because all of it's got to come from value creation. All of it's got to come from growth relative to the entry point. And when you look at the price being paid for a lot of venture deals, which are really rich, wow, can a $2 billion company become an $8 billion company, right? Because that's how you're going to generate the return. I think PE starts to optimize the capital structure a bit to give you that benefit of leverage.
That was a beautiful explanation. Thank you for breaking that down for us.
Thank you. You're welcome.
What are the dangers of using valuation as a scorecard?
I mean, it is a thing in the Valley, which is we've been through the unicorn thing and all of that, and raising money to $1 billion and all, and et cetera. I think it all ties back to the deals get priced to perfection, and not every company is going to deliver against perfection. There'll be risks in the market. There'll be a stumbling and et cetera. So you're setting yourself up for disappointment if you're using your valuations along the way as a scorecard, right? It's great. It's exciting. Gets everybody excited. We raise money at a $2 billion valuation and look at this, but we're doing 100 of revenue or whatever it might be. Wow, a long way to go make the company worth $4 billion and create a big outcome for everybody involved. Because now you've just brought on investors who are investing at that valuation, and they want to see, it might be good for you. You've been there early, but those new investors need to go see you get from 2 to 4, 2 to 5, 2 to 6 to see a return that they're happy with. It's a lot of pressure on a business, and not every company is going to get there. It's just, the reality. It's the math. Deals get priced to perfection. And so I do think there's a downside to using valuation as your scorecard of where you are versus, hey, take the dilution, right? Instead of raising 100 million at 2 billion and, only giving up 5%, let's just exaggerate, raise at $1 billion and give up 10%. Okay. That's a dramatic swing, but I'm just giving as an example. But now, if that company is on its way to being able to grow and compound away and ends up at a 3 billion exit, everybody's happy about that, right? And employees in their mind of okay, I'm worth this today versus I'm worth 2 billion today and we only got to 3, right? Or worse, we're worth 2 billion today and a few years down the road, I'm not even worth that anymore. So I do think it's tough. I get it. It becomes a way to attract employees and et cetera as a headline metric. I don't think it's the right metric. I don't think using valuation, I think it's what's our growth rate? What's our business look like? We're valued fairly. And if we execute and do well, we're going to go return, create a nice return for everyone, it's probably a better setup. And it takes a little bit of education for folks to understand how does equity work in a company as an employee and an option holder. But I think that's just a better setup. You're coming in at a fair value. We execute and do what we're supposed to. You're going to go out and make a nice return on your, you're going to make money on your options versus you got options at a 2 billion or 3 billion value. And now it's just a lot higher bar to go make money on that.
You mentioned using valuation as a marketing tool to recruit people. And I've always thought that's the most counterintuitive thing, because if you see a big headline that says achieves $3 billion valuation, you're like, oh, I want to go join that company. I look at it from the opposite perspective of like a lot of the upside that you thought was there before is actually taken away. Like, yes, they've had success, but you're going to come in now at a higher strike price.
You're going to have a higher strike price against your options. And yes, a 409A will probably be at a discount to the last round. But still, it's influenced dramatically by the last round, right? That is probably the number one input into that valuation. And yes, your options are now, to your point, at that strike price. I think, having done a bit of the venture game, having done, the CFO seat as well as running the people function, it takes a lot of explaining on what equity, means.
A lot.
Having equity in a startup, and it's not, you've won the lottery, free money, like, oh, there's a basis against my stock. Oh, there's a strike price against the stock. What is the value that represents? Oh, I see. Okay. What happens if I leave? Oh, I have to come out of pocket to exercise those options. I didn't anticipate that. It's, you've got to have be open-eyed going into a venture company around, yes, you catch it on the upswing. It's awesome, right? It's a lot of fun, growing, everybody makes money. It's awesome. But if you don't catch it on that swing where it's just up and to the right, which a lot of companies have been through, and now valuation was too high, that can be very painful and demotivating for folks.
And also the silent killer that most people don't realize until it's actually happened is dilution. They'll just do the back of the envelope math of, oh, I joined at 3 billion and we've raised 3 rounds and now we're at 10 billion. So I must have more than a 3X. And then they go to look and it's actually only like 1.5 or 2X because they've been diluted by 20% all 3 of those rounds.
Yeah, I think if you go to a startup, everybody should educate themselves well on what is equity compensation mean? How does it work? Exactly to your point. What does your entry point mean? Your hold period, like what it means if you leave. And then exactly that too. Like, hey, how should I think about dilution over time? And so when I give people a spreadsheet to help think about what can the company be worth? That's one of the factors, right? Hey, we're 100 million shares outstanding today. Here's what our price per share, but let's assume we're at 200 million shares, just saying, down the road when we exit, just because we've had to raise capital, got to factor that in. So yes, I think educating yourself well on how equity compensation works is important if you're going to go to a venture-backed company.
I totally subscribe to your beliefs here around valuation and success. And maybe just to revisit the founder's point of view for a sec here, how should founders reset their mindset around what success looks like?
Yeah, it's a great question. As a founder, I guess you just have to say, okay, what is important to me, right? Is it being that hot company in the space for which nothing wrong with that, right? Go get the attention you deserve. But if you're using valuation as one of the measures, well, now you've better be damn sure about your ability to go deliver a return on that. So that I would caution on that. But it is an environment in which being seen as a cool company on the rise is important for recruiting and things like that. And you're starting a business for a number of reasons, ultimately, not just for the financial journey, right? You really have a passion to go solve a problem for your customers. It starts there. Like, there's no doubt that that's got to be where it starts. And then along the way, you got to build a great business behind it. The venture model will push you to be thinking to the moon. Like, it's just, you should be thinking to the moon. And I think you have to ask yourself, is that like what I see here? Is that what I want? And then take the risks that come with that. You may not want to raise venture money. You may want to say, you know what? I don't need $50 million. I need 10 to go execute on my business plan. And I get to break even and I can build a really profitable business and control my destiny. And I'm happier with that. That's a good outcome for a lot of companies. You're not going to be written up in the trade ranks, but you can go build something meaningful and maybe retain more control. If I want to be able to attract the best talent, grab that attention in the valley, shoot for the moon, that's what venture is for. I'm going for the big home run. Ultimately, I think that's what venture is for. You're not there for the doubles and triples. And if you get it right, man, it's an amazing ride and everybody's excited and you do well and it's fame and fortune are yours. But if it's not, then now you've put yourself in that game. So what do you do? And hey, guess what? You built a $100 million company. Amazing. But you're not worth what, the venture investors wanted. And Now your employees are disappointed. It's like, hey, where are you with that? And a lot of companies in SaaS, as you know, are dealing with that. So just know the game you're signing up for, I think, and what it is that's important to you. Because there's many ways to build a great company, right? And raising capital is important, but it doesn't have to be the venture, go for the home run model. Not all companies are built for that.
And so far, we've touched upon what good growth looks like at different stages of a business's life cycle. I was looking at your resume, and you were at Square when Jack Dorsey seeded a second billion-dollar business within the same company. And so what blew me away about that is like, this is a company that's already at a massive scale. And now you have this other engine and taking this, what seems like a pretty big risk at this scale, which doesn't always jive with what you would think at a public company of like the risk return and the trade-offs of what we're going to do and how much we're willing to lean forward on this. Can you just unpack for me like what you thought of that choice at the time and going into the consumer space?
Yeah, it was underway when I joined and didn't know much about it because Square didn't talk too much about it in its early days of Cash App, kind of keeping it below the radar. And so, coming over from, I was at PayPal previous to Square. And so PayPal obviously is a two-sided network, huge consumer wallet, over 100 million people on it. And then Cash, and then you had Venmo, which was, on fire at the time, just going viral, especially with millennials, et cetera. And so the thought of entering into that market with a third network if you had done the MBA analysis on that, it wouldn't have made sense, right? These are natural network effect businesses, two sides of a network, more people sending money, more people receiving. And you already had two out there, which had grabbed a lot of the market. And you had the banks getting into it with Zelle. And ultimately, it comes back to, I think, the vision and confidence that, Jack had in wanting to have a consumer business. And so, as I mentioned, that was already underway and it was fledgling, but it was really starting to pick up. And the team was extremely, it was a guerrilla kind of marketing effort out there in the field to go start to build traction and then eventually scale up as it did. So if you had just done the MBA analysis, you would have said, doesn't make sense.
Right.
However, and I think Jack's, and he's been now obviously an entrepreneur across several great businesses, was no, like we have our first $1 billion business, but that's not good enough. What's going to be our next $1 billion business? And one that has synergy between the two. And so it was very keen on that. Before, to your point, it was needed. Before, the Square business started to mature a bit in its end market. And it did create the next lever of growth without a doubt, right? For I guess Block now, and is now, larger than the core Square business. So that was just his foresight. And I think you just lean in, you lean into the ambition of a founder. Now doing that as a public company, I know you and I were chatting earlier, and to the point of risk, you don't get unlimited resources to go do that. You can, if you think at what, Meta did and Zuckerberg did, is he plowed a ton of money into the metaverse. This is my bet. And he hit profitability and it didn't work out. And to his credit, he pivoted away from it, but it did hurt the stock a lot when he was doing it. People said, what the hell's going on? I know you as this social media business. Now you're plowing into this bet that you have. And you can see once he pulled back from that, pivoted back and to profitability and just the core business, it's been remarkably successful. But that wasn't the play here. So the play was to go ring fence how much investment would go into Cash App, knowing that initially, at least, that was pure burn, but with the bet that eventually it could become something. And so we, as a public company, did have to constrain the amount of investment in that business. But it also forced the team to do some really creative things. A lot of the marketing was on podcasts in areas where, CPMs are really cheap. And just getting in, I mentioned that kind of guerrilla marketing, getting into places where, because the constraint was there, how do we start to monetize earlier? And so one of the things, which was instant deposit, which is you can get your money out of your wallet into your bank account instantly, was a result of needing to think, kind of necessity, the mother of invention, thinking creatively about how to monetize early. Because otherwise, a two-sided just P2P network doesn't monetize, right? Yeah. It has to be somewhere where you're spending that money or taking it off the chain to go get it, not the chain, the network. It's not blockchain here, but get it off the network. So that was what we were able to do and push the team a little bit early to think creatively around monetization. And that's what ended up, I think, helping them just be really gritty in the early days.
As a finance leader of a public company, are you sitting there thinking how much leeway do I have here?
Yeah, I mean, I think what's interesting. It's probably one of the more interesting places to be in finance is an incredible, obviously, entrepreneur,
Yeah.
a proven leader, built Twitter, and now has built another great company with Square. And it's like, all right, I've got my next thing that we're going to go do. You're not going to step in front of that necessarily and say, nah, it doesn't make sense, right? And you're not in that position, but you are now a public company. And obviously, this was, I was just part of the finance team. You had Sarah Fryer and others there kind of driving a lot of the day-to-day with Jack. But the discussion was around, hey, we do need to go show to the street the path to profitability. I joined about a year and a half after the IPO. So we were just getting to EBITDA profitability and then ultimately to GAAP profitability, right? And so those are important benchmarks for public investors to be like, hey, show me not only that your business model can, but you have the discipline to achieve those. And those were significant unlocks for the business. You looked at the valuation going from, single digits up to 70 or 80. That was a significant part of that was proving out the business model, et cetera. So you had to continue to do that and deliver that to the street, but at the same time, leave some room for investment in the business for things like that, right? And so that was the balance that you have to walk as a finance leader in a company in that environment.
Your resume is just full of all these incredible transformations. And another one that I spotted was when you were at PayPal, they spun out from eBay under activist pressure. What's your biggest takeaway from leading finance through such a pivotal moment?
Yeah, it's interesting. And I'm actually now at another, company that was taken private called EngageSmart, which is now separating out into two businesses. The one I'm with, Simple Practice, and then a sister company called Invoice Cloud. We're going through a separation. So PayPal was that relationship. I know there's a lot written in the Valley and, on the history and some of the animosity between the companies and all that, what have you. I think it was a very powerful relationship for PayPal to be part of eBay because, PayPal and eBay got started both at the origins of e-commerce. And PayPal was, it obviously had gone public, as you know, and it was building, being the sort of the digital currency, if you will, for the internet. But ultimately, you also needed distribution for that. And I think it solved a problem for eBay as well, which was to create safe and secure way for people to pay, et cetera. So being attached, I think, to that auction business was powerful. And then as eBay went into new countries and went into new forms of commerce, PayPal was able to benefit from that as well. And so it was truly an unlock for the then And when you looked at then it went off platform into just its merchant business was, hey, we can do that. We've done this for eBay. We can do this for any e-commerce merchant around the world. And that became its unlock. And so roll forward, eBay was becoming a smaller and smaller part of the PayPal business. And, in some ways, PayPal had, tons of running room still ahead of it. And so I think it would have been natural for the businesses to at some point consider that separation. I think, as you mentioned, the shareholder activity kind of forced that timeline probably a little bit, and then forced that to happen. But when you looked at it, as a spin out, I think it was a 40 billion valuation. It came out. PayPal was an extremely attractive standalone business, and so it made sense. So if you think about evolution of a business, great for its early growth, and then ultimately with eBay getting a bit more mature, more of a really value play, and you've got, if you think about public investors, and then PayPal still this growth play with great profitability, but more for tech investors. It made sense to separate and unlock value for both businesses. So yeah, it got accelerated, the timeline, but it made sense when you looked at it as far as where both the companies were.
You said that so eloquently, because if you're a shareholder in eBay at the time, you're probably looking at it like there's a lot of value that could be unlocked if these two were separated, right? Because eBay is probably getting a lower growth, more mature company multiple.
That's exactly what Carl Icahn and team thought, as they called it the jewel in the crown, and said this business should be on its own. And that was, and so that was the right answer. It may have happened organically. It's just that there was still a strong dependence on eBay. I think when PayPal went out, I want to say eBay was still maybe 25 or 30% of its volume. So it was coming down, but you still had major, large customer risk as far as exposure to eBay.
Yeah.
But that was declining each year. And ultimately that actually relationship did change, and eBay is using other third-party payment providers now as well. But it wasn't so much of an overhang that it was going to hurt the valuation of the stock, right? PayPal was diversified enough at that point.
And I think as operators, it's important for us to still understand like the financial implications of that for shareholders, because it impacts how they think about how to get their value out of the business. So even if you're not the one who's making the decisions of like if we should split this out or not, like the rationale is something that you should still have top of mind.
I think it just comes back to capital allocation, come back to thinking from a perspective of, you know, where is this business? What market does it play in? What's its position? What kind of opportunity does it have it in front of it? And capitalize it the right way, right? And so, yes, to your point, eBay was gotten a little bit more mature. You had Amazon and other, obviously, types of e-commerce that were taking a lot more share. And so kind of, eBay had reached a point, we're still growing, but to your point, more focused on just paying back, cash flow and dividends back to shareholders, more of a true value play, while PayPal was demonstrating an ability to continue to grow and invest in its business, still with very good operating margins, but a different scale. So two different types of investors. So, set up the company for the cap structure and the ownership structure that is the right one for it.
This may be Silicon Valley lore, but was it true that PayPal was looking into Stripe and they ended up going with Braintree at the time?
Can't speak to it. I think PayPal obviously did acquire into the mobile commerce space.
Got it.
And that was interesting in that, PayPal had just built a dominant position in online e-commerce, right?
Yeah.
And just with the growth in that end market, was able to grow really nicely with that. Talking about, adding $1 billion, $2 billion of top line revenue a year. But the world started to change as the mobile phone became the means to conduct commerce. And that's a different type of play with, use cases like Airbnb and Uber, right? When you use those apps, you don't even think about the payment. It's in the background and it's done. It's seamless, right? So API integrations to pull down your credit card info, run the risk models, et cetera. Bit different from the checkout flow on e-commerce and a different infrastructure, a lot more API driven and modern. And so to continue to have a significant share there, PayPal had an offering there, but it became obvious that it would need to accelerate as more and more mobile commerce was taking share from traditional desktop e-commerce. And so that acquisition happened. And yes, you're right. They were in the same business, Braintree and Stripe. Stripe's obviously gone on from then and built an incredible business beyond just an original payment gateway into a lot of broader fintech services and, mobile banking and other things that it's playing in. So extreme, billing, very innovative business. But yeah, it was, at the time, it was the right play to go acquire a business and Braintree, was the one that lined up.
That was one of the best CFO political statements I've ever heard. So I applaud you. I applaud your candor and how you handled that. I have another question about PayPal and the evolution here, and it's kind of in the background of like this idea of a super app. Yeah. We recently spoke to Grab's CFO, Peter Oye, and he was telling us about how in Southeast Asia, it's a great idea and it just works culturally and with where people were with desktop versus mobile. Do you think that the US could ever have like an everything app, a super app?
Yeah, it's interesting. Having watched some of that, I think it starts with what's the existing infrastructure and is there a problem that the super app solves? And if you look at some of it's pretty amazing when like WeChat, which is like a messaging app, all of a sudden becomes a fintech app in payments, or, you've got Alipay getting into all forms of financial services. Well, it's probably because the other offerings didn't exist at the time. And so you didn't have an E-Trade perhaps. And I don't know this for sure, but I believe like you probably didn't have a consumer friendly online trading platform like an E-Trade. You probably didn't have, something for savings or like a virtual bank account and other things. In India, like credit card penetration is still very low, right? There hasn't been adoption. So now just something that digitizes cash payments, through a very easy to use app is now getting used everywhere, right? And you're selling groceries on the street and people are accepting digital payments. And so there's a infrastructure that didn't exist that the app solved. And the app said, hey, we already have a trusted relationship with customers. They're using us for messaging. Why not for payments? Why not for other? It's more and more is being done through the phone. So why not be that super app? I don't think the same exists here where there's a pain point to solve. And I think if you look at, Facebook tried to get into payments through Messenger, for example, or PayPal played around with being a super app and getting into other parts of the stack beyond payments into loyalty and other things, or even just offline payments. There wasn't necessarily a problem being solved. Things are so efficient in the United States in terms of like the offerings that you have as a consumer. So if I'm using E-Trade for brokerage, why do I need to put that into my social app, for example, right? I'm going to bifurcate more. And I think that's what we have here is things are bifurcated. So I think the opportunity, and it's efficient, right? I love my major bank, but if I want to do mobile banking with Chase, I can. right? And, it serves my purpose that I need. And for social, I've got my social platforms that are using, for that purpose. They don't necessarily mix. For investing in mutual funds, I've got access to all of that. I don't need one app to bring me that. It already exists. I think that's the challenge, is what is the problem you are solving as a super app, right? And I think if you're not, I think consumers are fine to just use the app that brings the best value for that particular use case.
That checks out to me.
Yeah. Yeah.
One more question about PayPal, if you don't mind. And it's related to expanding into new markets. And there are a lot of listeners out there who may be thinking to themselves, like, should we be international on day one when we launch our product? How do we think about, moving into different geographies over time? And you told me that early in your career, you actually worked on launching PayPal's payments dongle in Japan with SoftBank, a move that didn't ultimately pan out. Can you just speak to that experience and what it taught you about going international?
Yeah, it was pretty interesting. I think literally my first month in at PayPal, I was on a plane to Japan. And then much of that first year was done. You asked me about Braintree. Braintree was happening as I was going back and forth to Japan. So I didn't end up working on Braintree, but it was happening, and obviously knew about it, but was going back and forth to Japan in parallel to that deal happening. So Square announced as it was expanding internationally, an entry into Japan. And so PayPal, which wasn't yet fully offline, mind you, with a payment dongle of its own, announced we need to be in Japan too, understandable. And so signed up a deal with SoftBank to say, let's go be a partner. You help us distribute, payment services in Japan so we can have a play. And so that had gotten set up. And so when I joined, we were just in the early stages of that joint venture, and it's all public and was announced, and as well as the subsequent, as you mentioned, winding down. Now, what's interesting is you had a case where there's two things you're trying to pioneer: obviously a new country, but also for PayPal a new means of payment, which is that offline dongle, which wasn't its core business, right? Its core business was powering online e-commerce and giving you a payment button, managing risk, and all that. So you layer in that additional layer of risk, and then the final was for SoftBank. I mean, they were a telco. They were selling to SMBs. That was who the partnership was with. But they're used to selling software and telco services and other things, right? Broadband, not necessarily payments. And so you kind of had a compounding of things that were new. And when you do that, like, too many variables can be hard to overcome. And that was ended up being the case there. And where we just said, look, this is still nascent as a product line for PayPal. It is not even a market necessarily. It has a need for this solution today. There were some, domestic, companies popping up to do that. And so we actually looked at, hey, are there ways to, adjust this? Perhaps Yahoo Japan become the payment button for Yahoo Japan, which was still a very big e-commerce site at the time for the domestic market. Also a SoftBank property, but ultimately, the answer was to dissolve it. So super interesting in terms of just exploring a bet, pretty bold bet into a new market with a new product line with a major partner. Tons of learnings, and including negotiating deals in Japan, et cetera. But ultimately, got unwound because it wasn't the right kind of time or place. And you should do those. You should have those bets. And it was well considered. Just ultimately didn't end up being the right bet.
What I took from that is it's really hard to do a lot of new stuff at once.
I think so. I mean, I think when should a venture-backed company go international? I think if you've got product market fit, you've proven that, like you've shown that you have a way to go to market and sell directly or through partners, so you can replicate that model in another country. Yeah, you should probably, and the countries, the types of customers you appeal to are there. Yeah, you should probably go, right? But here you didn't have yet product market fit in the original product, which was an offline payment dongle for PayPal. So yes, hard to do multiple things at once.
Did you pick up any tips or tricks negotiating in a different culture?
I don't know if this was a tip, but this process went a few months. Okay. And the funny part was literally about 6 weeks in, we're making progress, on things we were trying to shift a bit the focus of the partnership. And we show up one morning and there's a totally new team from SoftBank on the other side of the table, absolutely new team. And I go, what happened to the other guys? They're like,
what happened to Bob?
We're taking this from here. They're like, okay, well, let's continue. They're like, no, we will start over. So, and there were reasons for that. There was a shift in the approach, and ultimately, why couldn't get to a negotiated deal. I think the interest had shifted a bit on the SoftBank side and how they were thinking about it. But that was like, wow, that was something else. That in the middle of it, there was a total shift in the entire team we were negotiating with. What were the learnings? I think I will say this. We spent a lot of time outside of the negotiating table with the SoftBank team, just getting to know the individuals, right? Because this is a high profile. You've got, you had an announcement with John Donahoe and Masa in the papers a year ago. Everybody's feeling pressure to make this work. Hey, who are the people on the other side? What did they got at stake? One of them is a product leader trying to build payments. The other is, on the corp dev side. And I think that helps is get to know the folks, because ultimately, everybody's trying to do their job and get something done and has a mandate. And that helped us break through issues along the way. And I think even when ultimately we came out to this is something that probably is not going to work, it was for the right reasons. It wasn't we couldn't reach a deal or, there was a misalignment or something. It was yeah, this is the right call. It's probably not the right thing. And some of those people have stayed in touch with and, become longer term relationships. So when you're in the intense experience like that, negotiating some pressure, just get to know the folks on the other side. I think that helps a lot.
That's great. Mohit, I'm going to take you into what we call our long ass lightning round. So you're an incredibly successful guy, but you got to give me one example of something that you've messed up on the job before. It could be in any role.
It's funny, and this will date me, but my banking career, my first year, we're going for a big pitch up in Boston from New York, pitch a couple of private equity firms on an acquisition and to be their advisor. And I get on the wrong flight. They
let you on the wrong plane?
I get on the wrong flight. I show up. There's a Boston shuttle from LaGuardia in New York. It goes every half hour, every hour. So I get there. I end up getting there early, actually, and I take it what turns out to be an earlier flight. So I'm okay, no big deal. But I'm on the wrong flight versus everybody else. And then, so I'll date myself. This is before analysts were given phones, or, we were just probably a year away from getting BlackBerries or whatever else. So there's no way to reach me. And so everybody freaked out and said, that kid's got the pitch books and all the materials. And that guy overslept. He's not here. And so one of the MDs happened to have one copy. And so, they get to Boston, and that MD is now run to Kinko's to run copies for this meeting, because it's, big pitch as going in running. And I show up at the office where we're going, and I swear to God, I probably shrunk 3 feet. Everybody's just giving me the death stare. And they're like, where were you? What happened? Why weren't you here? I was like, so what happened was I ended up taking an earlier flight, but it got delayed. So then they all got there first because my flight got delayed because it was cloudy. And so I show up, I've got the books, I'm on time, but because they couldn't reach me, they're like, there's an MD right now at Kinko's running 20 copies of that pitch book because you weren't here. And I took the meeting, went fine. We ended up winning the mandate, actually. It ended up being a pretty cool deal. And our first one with those sponsors in Boston. But man, that was, I definitely shrunk a couple of feet that day, and just was probably shrunk in my chair that whole meeting.
I would have been sweating through my sports jacket.
So kind of hard to imagine that problem existed today, given you would text someone and in an instant, but that was the state of play.
Next one, if you could tell your younger self something knowing what you know today, what would you tell him?
I think you just keep the relationships. I think you get so focused on getting into great roles, getting into, good opportunities, your body of work, but the people you're working with along the way, and then even the ones you have as who are more senior to you, super valuable just to have as mentors, have as fellow travelers on the journey. You're going to have some setbacks along the way. You're going to have others. And it's great to be able to just have people to call on and talk to, get advice, as well as who's going to help you as you go. So if I would look back a little bit more, maybe, don't work the extra hour that evening. And if folks are going out for after work and go, to get a drink or something, just go join, hang out, do that, invest in that. And not to say I think I've been able to thankfully build a pretty good group of mentors and others, but there's the numbers who I didn't keep, stay in touch with them. That would have been good. So invest in those personal relationships. It makes the journey richer just to have, people along the way, and you call and share memories, but also it can help you. It can help you as you build your career.
I can think of 10 people that I'm like, I wish I kept in touch with them. And now I'm like, is it too long to reach out? Is it weird if I reach out?
Exactly.
More of a technical one for you. Can you walk me through your finance software stack? What tools does your team use to get the job done?
So we're in the midst of evaluating, as many are, AI tools, but we haven't yet deployed anything. But we're on NetSuite, for our ERP. We're on Adaptive for our FP&A module. We're still on Concur. We'll see as we think about, we've been doing a separation as we went private as part of EngageSmart. So kind of building out our own stack now. But so it's not the most modern stack, but it works well enough. All in the cloud, obviously, everything, et cetera. So Workday, as we think about from the people side, Zip for procurement, which is a newer tool, which we've played around with as well. What am I missing? I think those are sort of some of the key components, right? Across FP&A, et cetera. And, I'm hoping that the existing incumbents, like I'd love for real-time forecasting in FP&A and for a recurring revenue business like ours, right?
Yep.
A slight change in churn or customer acquisition will ripple through the year, including if you've been delayed on some hires by 2 weeks, that savings is going to ripple through the year. And I'd love to know that faster, because if we're running, ahead in the current quarter, maybe we go back and invest and, put some of that into marketing. So I'd love real-time visibility, which is doable in a business like ours that isn't like cyclical or lumpy. So I'm hoping Adaptive will introduce some features. Let's see. Otherwise, we will certainly look at building some of that ourselves or ones that can. But I'm excited to create efficiency for the team through AI. Just get things done faster and less manual intervention. But we're on the front end of that right now.
Nice. We'll have to circle back to see how that's going. And I just want to flag, that's like such a great golden nugget for any of the FP&A folks out there. And also the vendors who listen to this podcast, like the real-time forecasting where it ripples through, that would be an absolute game changer.
Especially if you're a public company, you're probably each month doing a roll-up and looking at how you're doing and, making a call on if you have to hold off or can have room to invest more. So you're doing it. But I think AI can give you that much faster.
Last one I got for you. In all your years helming finance teams, what's the craziest thing you've ever had someone try to expense?
COVID was interesting, huh? So we got back in the office. We turned on, in my last company, Uber Eats, so you can, order lunch into the office. And the table for food delivery would be sitting in our foyer right outside the elevator on our floor. And I walk out one day and I there's always food being delivered. And I see this big plastic bag and there's stuff leaking out of the bag. I'm like, what the hell is this? So I take a peek and it was chicken on the bone, just raw chicken on the bone, 20 pieces. And so someone had done their groceries and had it delivered to the office and sitting there in the foyer. And so, a memo went out right away. Like, hey, this isn't for groceries. This is for ordering lunch in the office. So that was nasty, but then also was clearly not what that benefit was intended for.
And from COVID to salmonella, dangerous.
Yeah, dangerous. Exactly.
Mohit, this has been an absolute blast. I really appreciate you carving out time for us. Thanks for coming on the show.
No, thanks, CJ. Really enjoyed the conversation.
Run the Numbers is a mostly LLC production. Yelling an intro by Fat Joe. Artwork by some AI thingamajig. Podcast and video editing is done by Cleancast at cleancast.io. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of me, a guy who feeds his dog too much ice cream and has a history of net operating losses, LOL. If you like this podcast, please hit subscribe. It would mean a lot to me. And also check out mostlymetrics.com. That's my newsletter where I explore business models and financial metrics. Thanks for riding with me. Share this with your friends. Peace.